You're about to discover why 95% of investors lose money while a select few build generational wealth. Benjamin Graham, the man who taught Warren Buffett everything he knows, cracked the code in 1929, right before the market crashed and wiped out millions. While everyone else was jumping out of windows, Graham was taking notes. What he learned became the blueprint that created more millionaires than any other investment philosophy in history. But here's the brutal truth. This information has been publicly available for 70 years, and almost nobody follows it. Why? Because it requires something most people don't have. And in the next few minutes, you'll find out if you're part of the 5% who can actually execute, or the 95% who will stay exactly where they are. Graham said something that should terrify you. The investor's chief problem, and even his worst enemy, is likely to be himself. Let's find out if he was talking about you. Benjamin Graham wasn't born into wealth. He was born in London in 1894, and his family immigrated to New York when he was 1 year old. His father died when Graham was 9, and his mother lost everything trying to run a boarding house during the financial panic of 1907. He watched his family go from middle class to poverty overnight. He saw his mother's desperate attempts to day trade stocks with borrowed money, watching her lose everything again and again. This shaped everything. Graham grew up understanding that the stock market wasn't a game. It was a battlefield where the unprepared got slaughtered. But instead of avoiding it, he became obsessed with one question: is there a way to invest where you mathematically cannot lose? Not just probably won't lose, but structurally, mathematically cannot lose. He spent his entire career answering that question. And what he discovered was so powerful, so completely different from what everyone else was doing, that it seemed almost too simple. But that simplicity is exactly what makes it work. Graham didn't create a system for geniuses. He created a system that protects you from your own stupidity. And that's worth more than any amount of intelligence. Let's talk about what was happening in the investment world when Graham started. The 1920s were insane. Everyone was getting rich in stocks. Shoeshine boys were giving stock tips. People were mortgaging their homes to buy more shares. The market only went up. Everyone was a genius. Sound familiar? It should, because this pattern repeats every single generation. Graham watched this and felt something different than everyone else. Not excitement, terror. He saw people confusing a bull market with brains. He saw speculation being called investment. He saw prices disconnected from any underlying value. And he knew, mathematically, that this had to end in disaster. So while everyone else was celebrating, Graham was preparing. He developed a framework based on one core principle that changes everything. Price is what you pay. Value is what you get. Read that again, because most investors never understand the difference. They see a stock going up and think it's valuable. They see a stock going down and think it's worthless. Graham realized this is completely backwards. A stock going up might be becoming more expensive and therefore less valuable as an investment. A stock going down might be becoming cheaper and therefore more valuable. This inversion of common thinking is what separates professionals from amateurs. Here's where it gets interesting. Graham introduced a concept that sounds boring but is absolutely revolutionary: margin of safety. This is the entire game. Everything else is details. Margin of safety means you only buy something when it's selling for significantly less than it's actually worth. Not a little less, significantly less. Graham suggested buying at 2/3 of intrinsic value or less. Some of his best investments were bought at 1/3 or even 1/4 of what they were actually worth. Why does this matter so much? Because it protects you from being wrong. And you will be wrong. Graham was wrong all the time. Buffett is wrong all the time. Every investor is wrong constantly. But when you buy with a huge margin of safety, being wrong doesn't destroy you. Let's say you calculate a company is worth $100 per share. If you buy at $95, you have almost no margin of safety. If your analysis is even slightly off, you lose money. But if you buy at $50, you have 50% margin of safety. Your analysis can be significantly wrong, and you still make money. You can be half right and still win. This is the secret. Graham wasn't smarter than other investors. He just structured his investments so he didn't need to be smart. He needed to be approximately right and extremely patient. Now let's get tactical, because theory without application is worthless. Graham created specific criteria for selecting stocks. These aren't suggestions. They're requirements. Every single one must be met, or you don't buy. Period. First criterion, the company must be profitable. Sounds obvious, but you'd be shocked how many people invest in companies losing money, hoping they'll eventually figure it out. Graham said, no. Profits now or no investment. Second criterion, the company must have positive book value, meaning assets exceed liabilities. You're buying a piece of a real business with real assets, not just a story or a dream. Third criterion, the company must have a history of consistent earnings. Graham wanted to see at least 5 years of profitability. One good year means nothing. Consistency means the business model actually works. Fourth criterion, the company must pay dividends. This was non-negotiable for Graham. Dividends prove the company generates real cash and management is willing to share it with owners instead of wasting it. Fifth criterion, current assets must exceed current liabilities by at least double. This ensures the company can handle short-term problems without going bankrupt. Sixth criterion, long-term debt must be less than net current assets. This means the company could literally pay off all its long-term debt with just its current assets and still have money left over. Seventh criterion, price-to-earnings ratio must be reasonable, preferably under 15. You're not paying for hype or growth stories. You're paying for actual current earnings at a fair price. Eighth criterion, price-to-book ratio must be under 1.5, preferably under 1. This means you're buying assets at a discount to their stated value. Here's what's brutal about these criteria. In a bull market, almost nothing qualifies, and that's exactly the point. Graham's system automatically keeps you out of overpriced markets. When everyone is buying, you're sitting on cash, waiting. This feels terrible. Your friends are making money. Media is talking about new paradigms. You feel stupid sitting on the sidelines. But then the crash comes. It always comes. And suddenly the stocks that were $100 are now $30. The companies that were untouchable are now hated. Everyone who was buying is now selling in panic. And that's when Graham's system lights up like a Christmas tree. Suddenly dozens, hundreds of stocks meet all the criteria. You have more opportunities than you have capital, and you buy aggressively while everyone else is terrified. This is the cycle. Wait patiently during manias. Buy aggressively during panics. Graham did this for 40 years and never had a losing decade. Not one, even including the Great Depression. How? Because he only bought when he had margin of safety, and he had the psychological discipline to do nothing when conditions weren't right. Let's address what you're thinking. This sounds incredibly boring. Where's the excitement? Where's the 10-bagger? Where's the Tesla, the Amazon, the get-rich-quick story? And that's exactly why you'll probably stay poor. You're looking for excitement in a domain where excitement kills. Graham said the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. Translation: your emotions are your enemy. The market exists to serve you, not to instruct you. When it offers you stocks at bargain prices, you buy. When it offers them at inflated prices, you sell or do nothing. You don't let the market's mood swings affect your mood. You're not playing the same game as traders and speculators. They're trying to predict what the market will do tomorrow. You don't care what it does tomorrow. You care what a business is actually worth, and you wait until you can buy it for much less than that. Then you wait for the market to eventually recognize that value. Might take months, might take years. Doesn't matter. You have margin of safety, so time is your friend, not your enemy. Graham also introduced another concept that most investors ignore to their doom: Mr. Market. This is a mental model that changes everything. Imagine you own a business with a partner named Mr. Market. Every single day, Mr. Market offers to either buy your share of the business or sell you his share. Some days he's wildly optimistic and offers you a huge price. Other days he's depressed and offers you a tiny price. Here's the key. You don't have to accept either offer. You can just ignore him. Mr. Market will be back tomorrow with another offer, and the day after, and the day after that. He never gets offended if you ignore him. Now, most investors do something insane. They let Mr. Market tell them what their business is worth. If Mr. Market is optimistic and offers a high price, they think they're rich. If he's pessimistic and offers a low price, they think they're poor. They let a manic, depressive partner determine their self-worth and their decisions. Graham said this is absolute madness. You should use Mr. Market, not be used by him. When he's irrationally optimistic, sell to him. When he's irrationally pessimistic, buy from him. The rest of the time, ignore him completely and focus on what the business is actually worth based on its fundamentals. This framework alone, if you actually internalize it, will save you from 90% of investing mistakes. Now, let's talk about what happened when Graham's principles met reality during the worst financial crisis in history. In 1929, the stock market crashed. But it wasn't just a crash. It was an apocalypse that lasted years. By 1932, the market had lost 89% of its value. 89%. Companies that seemed invincible were bankrupt. Fortunes built over generations evaporated. Suicides were common. This was financial Armageddon. And Graham? He lost a lot initially because he was still refining his system. But here's what matters. He survived, he learned, and he documented everything. What emerged from that crucible was the most robust investment framework ever created. Graham realized that the crash happened because people confused market price with actual value. They bought stocks at 20, 30, 40 times earnings because prices kept rising. When reality hit, those stocks fell 90% and were still overvalued. But Graham noticed something else. In the wreckage, there were companies selling for less than just their cash in the bank. You could buy the entire company for less than the cash on the balance sheet, getting all the other assets, the business, the earnings for free. This seemed impossible, but it was real. Fear had driven prices so low that obvious bargains were everywhere for those brave enough and disciplined enough to buy. Graham started buying aggressively in 1932 and 1933. He focused on what he called net stocks. These were companies where the current assets minus all liabilities, both current and long-term, was higher than the entire market cap. You were literally buying dollars for 50 cents, sometimes for 30 cents. The market was giving away businesses for less than liquidation value. Graham bought dozens of these. He didn't need to know which specific ones would recover best. With margin of safety that large, he just needed most of them not to go bankrupt. And that's what happened. Over the next 5 years, those investments generated returns that seemed impossible. Some went up 500%, 1,000%. Not because Graham was predicting the future, but because he was buying value so cheap that recovery was almost inevitable. This experience shaped his philosophy forever. He realized that if you focus on price versus value, if you demand margin of safety, if you diversify among bargains rather than concentrate on predictions, you create a system that's almost impossible to lose with over time. Let me show you the math because numbers don't lie. Graham tracked his investment partnership returns from 1936 to 1956, 20 years. His average annual return was 17%. The market average was 12.2%. Doesn't sound like much difference, right? But compounded over 20 years. $10,000 invested with Graham became $159,000. The same $10,000 in the market index became $98,000. That's $61,000 difference, or 62% more wealth, just from that 5.8% annual edge. But here's what really matters. Graham had that edge with significantly less risk. His worst year was down 6.8%. The market's worst year was down 33%. So he made more money with less volatility and less psychological stress. This is the Holy Grail. Higher returns, lower risk. How? Margin of safety. When you only buy bargains, your downside is protected. When everyone else is losing 30%, you lose 6% or even make money because you can buy even better bargains. Now let's get real about why almost nobody follows this system despite it being publicly available for 70 years. First reason, it requires patience that borders on superhuman. You might wait months or years for opportunities. During bull markets, you do nothing while everyone else makes money and calls you stupid. This is psychologically brutal. Your ego wants action. The system demands waiting. Second reason, the stocks that qualify are usually hated. They're in industries having problems. They're companies nobody wants to talk about at parties. Buying them feels wrong because everyone around you thinks they're garbage. You're swimming against every social current. Third reason, there's no excitement, no story, no narrative. You're buying boring companies at cheap prices, not revolutionary technologies that will change the world. Humans are wired for stories. Graham's system ignores stories completely and focuses only on numbers. Fourth reason, it requires actual work. You have to read financial statements. You have to calculate intrinsic value. You have to track dozens or hundreds of companies waiting for them to hit your price. Most people want to buy based on tips or feelings, not analysis. Fifth reason, it produces steady, unspectacular returns rather than lottery ticket home runs. You're not going to 10x your money in 6 months. You're going to compound at 15 to 20% per year for decades. That doesn't create exciting stories to tell. But here's what Graham knew that most don't. Slow and steady doesn't just win the race. It's the only way to guarantee you finish the race. The investors chasing home runs eventually blow up. The ones following hot tips eventually lose everything. The ones buying based on emotion eventually capitulate at the worst possible time. Graham's students, the ones who actually followed the system, almost all became wealthy. Not famous, not exciting, just quietly, steadily wealthy. Warren Buffett is the most famous example, but there are hundreds of others you've never heard of. Doctors, lawyers, teachers, regular people who applied Graham's principles and retired with millions. They didn't need to be geniuses. They needed to be disciplined, patient, and willing to look foolish during bull markets. Let's talk about the modern objection. Graham's strategies don't work anymore because markets are efficient now. Everyone has information. Computers scan for bargains instantly. This is partially true and completely irrelevant. Yes, extreme net bargains are rarer now. But the core principle, buying with margin of safety, is timeless. It worked in 1930, it worked in 1970, it worked in 2008, it works today. The specific tactics evolve, but the strategy remains. In 2008, during the financial crisis, high-quality companies were selling at 5, 6, 7 times earnings. Solid businesses with strong balance sheets were treated like they were going bankrupt. If you had the discipline to buy during that panic, you made fortunes. In March 2020, when COVID hit, the same thing happened. The market dropped 40% in weeks. Amazing businesses were on sale. Those who bought and held made incredible returns. Graham's system would have screamed buy during both periods. But most people were paralyzed by fear, selling at the worst possible time instead of buying. Here's your action plan if you actually want to apply this. First, open a brokerage account if you don't have one. This sounds obvious, but most people never take this basic step. Second, start screening for stocks that meet Graham's criteria. Use free stock screeners online. Filter for profitable companies, reasonable P/E ratios, positive book value, low debt. Third, when you find candidates, dig into the financial statements. Look at the balance sheet, income statement, cash flow statement. Is this business actually making money consistently? Are assets real or inflated? Is debt manageable? Fourth, calculate a rough intrinsic value. There are various methods, but a simple one is 10 times normalized earnings plus current assets minus all liabilities. If the stock price is significantly below that, you have potential margin of safety. Fifth, don't buy just one. Graham recommended diversifying among at least 10 to 30 positions because you will be wrong sometimes. Diversification among bargains protects you. Sixth, ignore what the market does after you buy. It might go down more. Doesn't matter if you bought with margin of safety. It might go up fast. Great, but don't sell until it reaches fair value. Seventh, reinvest all dividends. Let compounding do its work. Eighth, wait for opportunities. If nothing meets your criteria, hold cash. Cash is a position. Waiting is an action. Ninth, when crisis comes and everything is on sale, deploy capital aggressively. This is when you make your returns for the next decade. 10th, repeat this process for 30 to 40 years and you will be wealthy. Not might be, will be. The math guarantees it if you follow the system. Benjamin Graham died in 1976, but his legacy is every wealthy investor you've ever heard of. Buffett calls him the best teacher he ever had. Graham didn't just teach investment theory. He taught a way of thinking that protects you from yourself. He taught that price and value are different things, that the market is there to serve you, not instruct you. That margin of safety is more important than potential upside. That patience and discipline beat intelligence and excitement every single time. These aren't just investment principles. They're life principles. The question isn't whether Graham's blueprint works. 70 years of evidence proves it works. The question is whether you have what it takes to follow it. Can you wait when others are buying? Can you buy when others are panicking? Can you ignore social pressure and focus on value? Can you be patient for years to let compounding work? Can you be boring and disciplined instead of exciting and reckless? Most people can't. And that's why most people stay poor despite having access to the exact blueprint for wealth. The information is free. The discipline is expensive. You now have the blueprint. What you do with it determines everything. If this opened your eyes to how investing actually works, share this with someone who needs to hear it. Subscribe because we don't sell dreams here. We teach systems that actually work. The choice is yours. See this and apply it, or ignore it and stay exactly where you are. Benjamin Graham showed you the path. Walking it is up to you.